the human nature of having interest rates that low from that long and the reciprocity of shooting rates up the fastest pace in history. If you look at it on a log normal basis, it is. On a global basis, all these central banks, it's just, I think it's irrational to not expect normal reciprocity in markets and in what's happened with what people have done um, during that low interest rate period. So that's why I'm looking for one of the most significant economic resets of a lifetime based on normal cycles. And that to me is a key part of it.
Bloomberg Intelligence's senior commodities analyst Mike McGlone believes that risk assets will be worse off if the U.S. defaults on its debt. According to the Bloomberg strategist, risk assets are likely to rally once an agreement on raising the U.S. debt ceiling is reached. McGlone says that the most likely outcome is that the market's reaction to a potential U.S. debt default will force the debt ceiling to be raised. Lingering economic growth concerns triggered by the March regional banking crisis and bank failures led to small losses for most commodity indexes. The UBS Constant Maturity Commodity Index, CMCI, fell 0.69%, while Bloomberg Commodity Index, BCOM, fell 0.75% in April. Industrial metals were the weakest sector during the month, falling by over 3%. The banking failures have investors worried about a credit crunch, leading to a weaker economy and falling demand for industrial metals. Zinc and copper each fell around 8%, contributing to greater losses for the sector overall. In this video, McGlone gives a macro outlook on the job market, interest rates, deflation, and the unavoidable reality of a recession. As you watch, make sure to like the video, subscribe, and drop your comments in the comment section.
My base case is we will go down that 20% in the equities, regardless of the oxymoron of default in U.S. government. That should never be something to be said. Maybe it'll be a delayed payment, but it'll all be worked out, and everybody will get their U.S. dollars. Let me print more, but we are seriously tilting towards a recession. The Federal Reserve is still tightening, and the job winning out of the Fed governors is significant. You cannot, don't fight the Fed has been one of my main mantras for well over a year, and it still is. That the key dichotomy you see is Fed fund futures price from right now to the end of the year, about 70 basis points of cuts. And virtually every economist, our chief economist, Anna Wong, our chief strategist, Ira Jersey, and most of the Fed governors said, we're not going to be cutting rates. Saying that, it means there's only one way for that really to happen, for the futures market to be right, and that is for the stock market to go down and make it happen, unfortunately, which might be led by Bitcoin. So the situation we're in right now, I see is mostly risk, lose for risk assets. And you're seeing that in commodities. There's significant deflationary forces showing up in commodities. So I look at the politics are all part of it. To me, it's the most overwhelming macro is that it's May. We just had a Fed hike. We've had 2 Fed hikes despite this banking crisis. And this is the kind of thing I think we're going to look back from the future and say, okay, well, we probably should never do that again because what resulted was a significant depression, maybe recession. It's a key thing. Now, I say that. I don't like to say it as McGlone has been my nickname I've earned, but just point out the facts of liquidity and history, which I love getting on your program. We've never had a pump in liquidity like we've had up to that peak of money supply around 26% in 22 to down negative now. Never had that. And we've never had the dump like we've had now in terms of not only just money supply, but you're seeing it in bank deposits receiving. And just the lessons of history say we should expect some form of reciprocity in economic activity. Not complicated at all. So that means in the stock market, maybe just a normal 50% peak to trough correction. We've had that in the last 2 recessions. The key thing is in the leading markets, it's already happening, Michael. Like if I look at the most significant measure of heat, electricity, and fertilizer in this country, natural gas has dropped to the same price as 1990. Significant deflationary forces. The Bloomberg Commodity Index is down 24% on a 1-year basis. Copper has just broken down in the year, pumped 12%. There's still these little things. So I look at politics and everything. Yeah, the debt crisis is a pretty significant tree, but the forest is that we are tilting down towards a severe recession, hasn't even started. And all the indications are right now, key question I'll leave you with is there's nothing I see on the radar at close that what can stop this downward trajectory at the moment.
After decades of near 0% interest rates, many bankers have been looking forward to the day when higher policy rates would give them the chance to charge more and profit more from day-to-day lending. But now that the U.S. Federal Reserve and the Bank of England have pushed rates to levels not seen since the 2008 financial crisis, bank executives are discovering that with rising rates has come a heightened need to manage interest rate risk more carefully.
To me, the base case from a year from now is we will be in severe deflationary situation. And it's already happening in commodities. I pointed out it's happening in yields, already pointing that out. It's happening in virtually every indicator I look at. You look at, here's one key fact. The producer price index around 2% now, last year's peak was 18 or so, is dropping at the fastest pace in history. And that goes back to 1948. Now that's got a 2 beta to CPI. Typically it runs ahead of it. If CPI is running 5%, PPI is usually 10%. It's a 2 beta. It's going to be negative when we print the June number on July 13th, and it might have might somewhat mimic the lowest level ever, which was from July 2008 at 2009 at 6.9%, because it's the measure. Crude oil peaked the year before, and it bottomed that during the measuring period, and it's just what happened. The Bloomberg Commodity Index in crude oil peaked in June of 2020 of last year. When we measure PPI for June of this year, it'll be from the absolute peak. It'll be a negative number. If not, it'll be heading towards severely negative. So that's significant deflation. So let's take PPI minus Fed funds. It's negative. It's around it's negative like 2.5%. It's seriously contractionary and recessionary. So here's the way I look at it, Knows all my indicators, everything I look at are showing towards severe deflation. I can point out, like I mentioned, commodities are down 24% on an annual basis. Copper's just broken down in the year. It was up on the year. The Fed we have a bank crisis. We had money supply contracting. Number one thing that Ben Bernanke pointed out when he wrote his essays on the Great Depression, there's one key measure that's on the cliff's edge for deflation. That's the stock market. So I think what's going to happen, risks of predictions, is the S&P 500 was right around 4 bid. I look at it as 4,000 bid. It's just going to go 4 offer and go down to 3. Now I say that I use these signals because I remember that in the trading bits. You'd see markets trading 1, 1, 2, 1, 2. Gold just was offered at 2 for years and it just went 2 bid. And I think it's going to end up going 3 bid. I just see that happening with the fundamentals. The stock market, now the S&P 500 has been hovering around this 4 level. It's 4 bid. And a lot of indications are saying it should go 4 off. And once it does, I think it drops to 3. In a normal recession, that is your basically on a 1 to 10 scale, that is everything kicking in at a 10 for severe enduring deflation. And here's one key fact I'll end with is the Federal Reserve will just never ease with the ease they have in the past because of the lessons they learned from easing too much and inflation that resulted.
The dangers first showed up publicly in banks' unrealized losses in their securities portfolios. Government securities are ordinarily considered super safe assets, but those that were purchased when interest rates were very low have been losing value as rates began to rise. In the U.S., these losses ballooned from just $8 billion at the end of 2021 to more than $620 billion at the end of 2022 for lenders insured by the Federal Deposit Insurance Corporation.
And we haven't even started this recession. So I think that's an unlikely scenario without significant Fed easing, and that's what's changed. So I like to point out what's different from a lot of people who say, oh, okay, once the Fed's done tightening, the stock market will do well. I remember that cycle in 1994. But you have to remember from where we came. We were just so expensive, the US stock market. So I look at it as I used to, I was in the trading pits in the 80s. I remember the Nikkei peaked in 90. It still hasn't got above that level, the Nikkei 225. You look at the Euro Stocks Index in Europe, I think it's the same price from 23 years ago, something like that. I could look at it in a second. So to me, that's the key thing. And that's why I rope in what's happening in treasuries. I look at it, this is also cyclical, and it's part of what's happening with demographics. Every boomer on this planet, when they saw that 2-year note go to 5%, they said, thank you. I mean, if they didn't, then they weren't advised well. And what happened, that was in March. And what's happened since then? So now it's offered at 4 at the moment. It's right around 4 yield. That's at 4 yield. I think it's going to go offered at 3, partly because we all realize, okay, we've had a great run. Time to check in and say thank you very much. And everything's tilting. I think we'd have to not get that recession. That's the highest probability since 1982 when you look at the yield curve. So here's another key factor. Look at unemployment. 3.2%, the lowest in how many years? Decades, 60 years or so?
Yeah.
There's never been a case of unemployment. And it's the stated goal of the Fed for unemployment to go higher. It's never been a case of unemployment prowling from such a low level without a severe recession, or not at least a recession. And then I look at things like, why is the price of natural gas, the most significant measure of heat, electricity, and fertilizer in this country, dropped 80% and down to the same price as 1990? Why is copper giving them back all its gains? Those are indications on a global basis of a lack of demand pull. And what normally happens to commodities, humans create more of it for less. So I think good luck with that one. Sometimes people like that might not say exactly what their positions reflect for different reasons. You got to be careful with that. But I look at it, I'll end with this. I'm completely worried that crypto's the fastest horse in the race on the way down last year, and everything's been up this year. Like I said, copper's given back that up. Cryptos are starting to give that back up. Will be one of the first indicators of everything starting to tilt back downward. And what's the stated goal of the Fed? Keep rates higher until they can reduce the ability for people to buy stuff. It's not what they said, but it's kind of my interpretation. It's also what Jim Bianco has said.
The Central Bank of Argentina raised its key interest rate Monday by 6 percentage points to 97% in an effort to tackle soaring inflation that has reached 30-year highs. Central banks across the globe are struggling to rein in inflation, but it's a particular problem in Argentina, where the annual inflation rate soared above 100% last month. That's the highest level since the early 1990s, and currently Venezuela and Zimbabwe are the only two countries experiencing higher inflation than Argentina, according to International Monetary Fund data. By comparison, inflation hovers below 5% in the U.S., where the central bank has raised key interest rates by 5 percentage points over 14 months. Argentina's central bank is also hoping the rate hike will incentivize investments in the country's currency, according to the central bank's statement released Monday. The exorbitant inflation resulted in large outflows of investments held in the Argentine peso, leading to a 23% decline in its value against the U.S. dollar this year. Ahead of a presidential election set for October, Economy Minister Sergio Massa is focused on avoiding an even bigger devaluation of the currency and containing inflation. He has been seen as a potential third-party candidate since incumbent President Alberto Fernandez announced last month that he won't seek re-election, and Massa's success is likely to be tied to the result of this inflation-battling plan. But the new rate hike is unlikely to bring any real change to Argentinian markets, analysts said. The feeling is that the government is completely losing it against inflation, said Miguel Kegel, a financial advisor and former deputy manager at the Central Bank of Argentina. I fear the government has started to act very late. Interest rate hikes are, of course, the main strategy to combat inflation, but they take time. Kegel told CNN and Espano on Monday, when a central bank raises the interest rate, the effects are felt some 2 or 3 months afterward, and that timescale is not effective in Argentina's situation. Do you think the U.S. upcoming elections have a part to play in the disappointing global economic outlook? Let us know your thoughts in the comment section below. Don't forget to like, subscribe, and turn on notifications. Thanks for watching.